DoubleDown Interactive, NASDAQ Q ticker DDI, posted a definitive beat for the second quarter. Revenue hit $94.3 million, which is up 11.2% year over year, and that beats estimates of $92.9 million. Earnings per share came in at 66 cents per American depositary share, comfortably beating the 61-cent consensus.
Right, and management actually withheld specific quantitative forward guidance this time around.
Yeah, due to current market volatility and, that ongoing take-private evaluation. But they did confirm marketing spend will remain stable.
Which is key.
Exactly. And as for the stock reaction, shares drifted up 2.61% during regular hours to $12.37 and tacked on another 0.49% after hours to hit $12.43. So a positive, but a very measured reaction from the market.
Okay, let's unpack this. If you are a retail investor looking at this stock today, or just trying to make sense of the social casino space in general, our mission for this deep dive is to tear down this Q2 2026 earnings report. We are cutting straight through the noise to understand how they achieve these margins, what's actually driving the underlying business, and why Wall Street seems to be holding its breath.
It's a really vital teardown to do, especially today, because, we need to immediately address this massive trap that caught a lot of retail investors this morning.
Oh, you're talking about the scanners?
Yeah, the automated scanners. If you have algorithmic stock trackers sending alerts to your phone, you might have seen them falsely reporting a staggering 2,188% earnings surprise for DoubleDown. Yeah, I saw those alerts hitting social media, 2,000%. Which, if you know anything about mature mobile gaming companies, that sounds completely impossible. The math just doesn't work. How does a glitch like that actually propagate across financial platforms?
It basically comes down to capital structure and, well, the blind spots of automated data scrapers. DoubleDown's underlying equity is represented by common shares, but what you actually trade on the NASDAQ Q here in the U.S. are ADS American Depositary Shares.
Right.
It's a really common vehicle for companies with foreign ties. Like DoubleDown has a massive footprint in Seattle, but its controlling parent company is actually in South Korea. The key here is that one ADS represents exactly 0.05 of a common share, so it's a 20-to-1 ratio.
Oh, wow. So the bots scraped the earnings report, saw the $13.27 in earnings for a full common share, and just mistakenly compared that massive number against the 58 to 61 cent consensus estimate for a single ADS fraction.
That is the exact error, yeah. When you do the actual conversion, multiplying that $13.27 by 0.05, you arrive at the real ADS earnings of 66 cents.
Makes sense.
So yes, it is a definitive beat, but it's a solid single-digit percentage beat, not some miraculous 2,000% windfall. It's just a perfect reminder for anyone listening, you cannot blindly trust automated financial scanners without understanding the underlying share mechanics.
You always have to look under the hood. And, looking under the hood of their segment performance reveals a pretty glaring paradox. Industry analysts at Eulers and Krechik recently put out a forecast stating the global social casino market is going to decline by over 5% in 2026.
Right, a real contraction.
Exactly. Consumers are pulling back. Yet, DoubleDown's social casino segment grew 11.5% to $77.3 million. And their iGaming segment, which is driven by the Sopanadism subsidiary, and their new Las Vegas brand, that grew 9.8%.
Achieving near double-digit growth against a 5% macroeconomic contraction that's what makes this quarter stand out. But you have to dig into the key performance indicators to see the actual mechanics of that growth.
Well, let me jump in there because I look at that 11.5% bump in social casino revenue and I see inorganic growth. A huge chunk of that is heavily driven by their acquisition of WHOW Games last year. If we strip away the acquired revenue from WHOW, isn't the underlying core business likely deteriorating right in line with that 5% industry contraction?
What's fascinating here is how the integration of WHOW Games completely altered DoubleDown's DNA. It does mask the organic baseline, you're right. But let's break down the KPIs to see how the player base has actually evolved. Because of the WHOW acquisition, DoubleDown's overall payer conversion, meaning the percentage of free players who actually decide to pull out a credit card and spend real money, that jumped from 7.0% up to 9.4%.
That's a huge jump for mobile.
It is. And on top of that, their average revenue per daily active user, which the industry calls ARPDAU, pushed up from $1.33 to $1.42.
Okay, so more people are paying, and the average daily revenue per user is ticking up. But WHOW Games operates in a very different demographic, right?
Yeah.
Like, they cater to a European market with a completely different spending profile.
They do, and this is where the economics of mobile gaming get really fascinating. Mobile games usually rely on whales, right?
Right, that tiny percentage of players who spend massive amounts of money subsidizing all the free players.
Exactly. But WHOW games brought in a massive volume of lower-tier spenders. So while more total people are paying, the average monthly revenue per payer actually dropped significantly. It fell from $286 in Q2 of last year down to $218 this quarter.
Okay, so they basically widened the pool of paying players, but made it significantly shallower. They diluted their whales with this huge influx of casual spenders just dropping like $5 or $10 a month.
In a contracting broader market, acquiring WHOW allowed them to buy market share and volume, but it fundamentally shifted their internal economics. They traded a smaller group of high spenders for a much larger, more diverse group of casual spenders.
But wait, if the average paying player is dropping $68 less every single month, how is DoubleDown's adjusted EBITDA jumping 17.2% to $39.3 million? I mean, revenue per payer is down, yet their profit margins expanded from 39.5% to 41.6%. Math like that requires a structural change in how money is actually moving through the system.
It requires changing the plumbing of the transactions entirely. The answer to that margin expansion lies in their direct-to-consumer, or DTC, pivot. DTC revenue skyrocketed this quarter to $40.5 million.
Wow.
Yeah, to contextualize that for you, DTC now accounts for a massive 52.4% of all their social casino revenue. Just a year ago, in Q2, it was only 15.4%.
Okay, here's where it gets really interesting. Think of Apple and Google, like Uber Eats or DoorDash for mobile apps. When a player buys virtual chips in a game through the App Store, Apple acts as the delivery service and takes a 30% toll booth fee off the top of every single transaction.
Right, the infamous Apple tax.
Exactly. If a player spends $10, Apple takes $3. If your profit margin was only $4 to begin with, Apple just ate 75% of your profit.
That 30% platform tax has been the single biggest drag on gaming margins for a decade. But by successfully routing 52.4% of their players through their own proprietary web storefronts, DoubleDown is completely bypassing that toll booth. They process the payment themselves.
That 30% isn't just a slight efficiency gain. It dropped straight down to the bottom line as pure profit. That is how your overall margins can expand, even when your average casual player from WHOW Games is spending less per month.
If we look at the broader strategy, this really explains the true value of the WHOW Games acquisition. WHOW brought in those lower-tier spenders. If you can migrate a player who only spends $10 off the App Store and onto your own DTC platform, the margin profile of that $10 purchase suddenly becomes incredibly attractive. And management made it very clear on the call that 52.4% is not the ceiling.
But getting a mobile user to leave a native app, open a web browser, log in, and type in their credit card information is notoriously difficult.
Yeah.
The psychological friction is huge. Usually, gaming companies have to offer massive financial incentives, like offering double the virtual chips if you buy on the website, which ends up diluting the very margin they were trying to save in the first place.
Management specifically stated they are avoiding that trap. They plan to migrate even more high-value players using exclusive live ops features rather than margin-dilutive financial incentives.
Live ops being live operations, right? Dynamic scheduled in-game events. So instead of cheap chips, we're talking about a weekend slot tournament, a special boss battle, or a VIP leaderboard that you can only access if you log in through their direct web portal.
Exactly. They are using product differentiation to drive the migration. You protect the pricing integrity of your virtual currency, but you give the player a compelling gameplay reason to jump over the psychological friction of leaving the app. It's honestly a masterclass in margin protection during an industry downturn, effectively capturing that full 30% margin from the platforms without devaluing their own product.
All this margin protection and toll booth dodging inevitably leads us to the cash pile. And this is where the valuation anomaly on their balance sheet gets almost surreal. DoubleDown generated $24.6 million in net operating cash flow just in this quarter alone.
The cash generation is undeniably robust. When you look at their balance sheet as of June 30th, they are now sitting on an aggregate net cash position of $521.3 million.
Over $500 million in cash.
Yeah. Let's break down the math for anyone evaluating the stock, because the valuation disconnect here is stark. That $521.3 million cash pile equates to roughly $10.52 per ADS in pure cash.
Wait, so if I buy a share today at $12.43, I am effectively buying $10.52 in cash sitting in a bank account, which means I am acquiring the actual highly profitable, margin-expanding casino business for less than $2 a share.
The market is assigning an incredibly low enterprise value to a company generating over $39 million in quarterly adjusted EBITDA. This massive cash-to-market cap ratio is exactly why institutional investors, like Boston Partners, recently took a 6.66% passive stake in the company.
That makes total sense.
Right. To a fundamental value investor, the operating business is trading at a steep, almost illogical discount.
So what does this all mean for retail investors? If the cash flow is this strong and the DTC migration is working and the valuation is mathematically this cheap, why does Wall Street maintain a consensus hold rating? Why is the market valuing the operating business at $2 a share?
Because the market hates uncertainty. And DoubleDown has two very specific heavy clouds hanging over its corporate structure. Let's break down the risks keeping the stock grounded. Risk one is the UK gambling tax hike, which directly impacts their supernation iGaming business. The UK recently raised the point of consumption tax on remote gaming.
Point of consumption meaning it doesn't matter where the company is headquartered. If the player tapping the screen is sitting in a pub in London, the UK government is taxing that transaction at a higher rate.
Correct. DoubleDown's management noted they are aggressively mitigating this, though. They aren't just taking the hit to their margins. They are tweaking game mechanics, altering promotional bonuses, and adjusting return-to-player or RTP percentages.
Return-to-player is the mathematical payout rate. If a game has a 95% RTP, it means for every $100 wagered, it is programmed to pay back $95 in winnings over the long haul. So adjusting that means the games are literally being tightened to pay out slightly less over time to compensate for the tax burden.
It is the most direct mitigation strategy available, but it comes with a continuous risk. If you tighten the payouts too much, the player feels like the game has gone cold. The entertainment value drops, and you risk losing player engagement entirely.
Right, it's a tightrope.
It requires a very delicate balance. But as significant as the UK tax issue is, it is minor compared to risk two.
The elephant in the room. The take-private overhang. This is what explains the $2 enterprise value.
It is the primary reason the stock is stuck in neutral. DoubleDown's controlling shareholder is a South Korean entity called W Games. They already own a massive chunk of the company, and they formally offered to buy all the remaining outstanding shares for $11.25 per ADS in cash.
But the stock is trading at $12.43. The market is looking at an $11.25 offer and actively trading above it.
Which tells you everything you need to know about market sentiment regarding this deal. The market clearly believes the bid of $11.25 is fundamentally too low, especially considering there is $10.52 per share in pure cash on the balance sheet. Offering $11.25 essentially values the entire operating business at 73 cents a share. A special committee of independent directors is currently reviewing the offer. Their job is to protect the retail investors from being squeezed out by the majority shareholder at an unfair price.
It's a total lowball offer, and the market knows it. But the real problem for investors today is the total radio silence, isn't it? During the earnings call, management offered absolutely zero updates on this front. They just read a prepared safe harbor statement acknowledging the special committee is evaluating the offer, and they refused to take questions on it or comment further.
This leaves retail investors in a complete holding pattern limbo. You have a highly profitable company trading at a near zero enterprise value, but you cannot confidently buy in. If the controlling shareholder somehow forces the buyout through at the lowball price, you lose money. If the deal collapses completely, there could be a short-term panic sell-off. The corporate governance situation acts as a lead weight, basically trapping the stock.
It creates an artificial ceiling and floor. You can have the best operating quarter in the world. You can beat the industry contraction. You can migrate half your users away from Apple's toll booth. But until there is a definitive resolution on the take-private offer, the stock is likely going to remain detached from its actual operational performance.
It is the ultimate lesson in distinguishing between a highly efficient operating company and a viable stock investment at a specific moment in time. The operations are stellar. The investment thesis is just, well, it's complicated by the parent company's maneuvers.
Now, to wrap things up, I want to leave you with a broader industry question to mull over. We just watched DoubleDown prove, definitively, that it is entirely possible to migrate over half of a mobile gaming audience to direct, off App Store payment channels using live ops and exclusive web features. As the broader social casino market contracts by 5% this year, forcing every developer to hunt for cost savings, will DoubleDown's success trigger a mass exodus? Are we about to see major gaming publishers abandoning the Apple and Google ecosystems entirely just to protect their margins? I mean, if dodging a 30% toll booth becomes the difference between growth and contraction, the App Store wars might just be getting started. That is all for today's analysis. Make sure you follow the show for daily, no-nonsense earnings coverage and analysis just like this. We will see you tomorrow.